The market's having trouble balancing whether we're at peak earnings and peak growth or just peak growth. And our view is that we're at peak growth, but not peak earnings. So underlying the EPS story is a very strong economy. We're going to see continued earnings growth, and stock prices will move higher. Stock prices are going to follow earnings. Earnings are going to follow the economy. And the concerns about global slowdown or Fed tightening, they're not really concerns of ours right now.
Have we seen enough, Jim Lebenthal, to say that the correction's over, that we put in a bottom in October, and that we're going to have a slow and steady move higher between now and the end of the year? You got 40 days left.
Yeah.
40 days to trade this market.
You know what, Scott? You can't answer the question. It all hinges, in my opinion, or most of it hinges on how talks with China go. And we've seen that this week. You know, beginning of the week, Trump was threatening more tariffs if President Xi didn't come to the G20 meeting with serious proposals, and the market sold off. In the last 3 days, we've seen him talk to President Xi, say positive things, and the market rises. Frankly, that's the way this market is going to go. There are certainly other risks. What will the Fed do? But I think the biggest risk here and what changes the market direction is the sentiment about whether the China trade war issue is softening or getting worse.
So, Shannon, we can't say that the correction is over until we get even more clarity on this issue with China?
I think we need more clarity on China, and I think people need to come to grips with the fact that the Fed is still going to be on path. We saw the great jobs number today. I think, you know, if you ask analysts and you ask portfolio managers, are we going to be positive in the equity markets next year? It's a resounding yes, but the path dependency there is all over the map. And so I think we've still got a little bit of time left here to feel some pain.
Okay, Josh Brown, I need your thoughts here.
Well, look, if you look at the employment report this morning, you got a really hot wage growth number, which is phenomenal for Main Street. It may not be the best thing for forward stock multiples because it keeps the Fed vigilant and probably locks in, among some other data points, what's going to happen in December, which is another quarter basis point hike. Historically, that's not a negative for stocks, but it definitely doesn't augur well if you think you're going to get expanding multiples. It's just not what takes place. But I think the market gets this. And as evidence of that, take a look of all the sectors in the S&P 500 on a one-year basis. The top performer, and it ain't even close, most people might assume it's tech, but it's not. It's consumer discretionary, up 18% year over year. Almost nothing else even close. The closest you get is tech, which is 10%. And then you've got some sectors year over year that are actually negative. So the consumer is the best part of the economy. I agree with Rich's point that earnings can continue to be good, but maybe you've seen as good GDP growth as you could expect for a while. I just don't think that's the end of the world.